to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, your tax depreciation experts. Now, we are talking a little bit about tax today. This is our tax time special, and we're going to talk about self-managed super funds. And we've got an absolute guru accountant who's really in rarefied air when it comes to his knowledge of self-managed super funds and, of course, his enthusiasm for all things tax related as well. We've got Munzurul Khan from KHI Partners, who's going to go through self-managed super funds from start to finish. What are they as an entity and how are they set up? What are the costs involved in setting it up and the ongoing costs? What sort of balance should you have before you think about starting a self-managed super fund? Whether it's going to be right for you and how to tell, and all the things that you need to know as a property investor to understand self-managed super funds and have a great conversation about it with your financial planner and your accountant. It's an amazing interview with an amazing guy who's got so much knowledge in the space and is so open with his delivery and his enthusiasm for it. Here's Munzurul. Munzurul Khan, thanks for joining me on Geared for Growth.
Thank you very much. Thank you, Mike. Absolute privilege. Thank you.
You're someone I've actually wanted to get on the podcast for probably 3 or 4 years, at least, since I knew exactly who you were. But you're such a busy man to pin down, but we've managed to get you today for our special sort of insight as part of our tax series on self-managed super funds. And self-managed super funds are something that property investors know all very well. There's all sorts of industries that encourage people to set up super funds so they can invest in property, spruikers, some of them you could call. But I wanted to get the lowdown on self-managed super funds from yourself, Munzurul, as an expert in that space. Can you start us off with an idea about, is there sort of a figure that you think is a minimum amount that someone should have in their super fund before they decide to set up a self-managed super fund?
Very good. Very good. Mike, that's a good way to start. And the reason I say this is that it's all about the effectiveness, efficiency, and I suppose the practicality behind it as well. Now, we've seen a whole bunch of self-managed super fund where some providers try to establish at, say, 70 grand, 100 grand, 120, 150, a whole lot of different numbers as such. Now, there is no one number in terms of how much you need to establish a self-managed super fund, because it depends on what your investment strategy is, what you wish to do, how you wish to do. But we follow very closely of the regulators, the guidelines, and the guidelines from ASIC is that anything below 250, perhaps there is not a whole lot of a value proposition in between the cost and the benefit as such. So that's a sort of a general guideline that we do, is that we start with 250 odd grand. We sort of say higher than 250 odd grand that you can have as a combined membership, which is between the husband and wife both. Yep. You can have up to 6 members, right? But between husband and wife both, 250,000 plus is where we say it may be worthwhile to discuss.
Yeah, so there's no statutory figure to say you have to have X, Y, Z, but I suppose if you're paying someone, you could have a financial advisor that you're paying $50,000 a year for their brilliant advice. Now, if you've got a balance of $100 million to invest, that could be minute. But if you've only got $100,000 to invest, you've got to cover the cost of paying that person and the returns aren't going to be there. So is that probably the best way to consider the value point for setting up that super fund?
But absolutely, because I look into that cost and the benefit side of it, right? So I'll give you one analogy in terms of the self-managed super fund. That 250 odd grand is a bit of an ASIC guidelines, and higher than that, higher it is, we do say right. But where the guidelines in my mind sort of make sense, where the math sort of makes sense, is that self-managed super fund, when you establish, you've got to have quite clear investment strategy. Why are you establishing it? What's the purpose? What are the investments that you're trying to do? You actually have to sit down with a financial planner to receive this concept called statement of advice. Yep. Until that statement of advice is done, one cannot establish a superannuation fund. And the 250 is that if, let's say, someone utilizes for investment property as an example, is that depending on various matters, but generally speaking, is that you can get up to 80% LVR if your serviceability is there. So 80% LVR means that you use your 250 odd grand for 20% deposit plus 5% incidental. means that you can buy, let's say, up to close to about $1 million property, or maybe slightly lower. But of course, it depends on how much is your superannuation contribution, how much is the income, how much is the rental property income. There's many disclaimers what it depends, but at a very high level, about $1 million or so. I compared that with what is the running cost of a self-managed super fund. You've got an accountant's fee, you've got an auditor's fee, and you've got to pay 2 lots of AC fee. And if we generally budget anywhere between, say, 4,000 to 5,000 to pay for all of those an annual cost, if I divide, let's say, 4,500 against that $1 million, I get a 0.45% as sort of your running cost. Now, one may argue that many of the industry fund ranges anywhere between 0.5 to all the way to 3.5%. So while you've got 250, if you use the leverage, your cost on a leverage gross value seems to be at a level where the cost is what you are already paying on the industry fund, if not a little bit lower. From that perspective, in my mind, cost-wise, around that 250 or a bit more, it makes sense.
Yeah, and that's a really good way to look at it. You've got to cover 0.5% let's say you've got 0.5% to assign to the ongoing costs, and then whatever percentage growth you've got on top of that is the growth for the super fund. But to me, it seems like the real power is the leverage, right? Because we've gone from a $250,000 asset base, which is unleveraged, to now being able to enjoy the returns of perhaps something close to $1 million property, right?
Yeah, and we say that too when our clients want to establish the self-managed super fund. We sort of say that, look, while we're not financial planners, we can't give you the financial planning advice. And that's where you go through with your statement of advice, whether the super fund is right to you. But what I do share is that I have established my own self-managed super fund, and my logic was exactly what he just said. So if 250 odd grand can be utilized up to $1 million purchase, I do the maths and I sort of say that, well, whether the property prices sort of increases anywhere between, say, 5, 7, 10% on average on a growth. And it's poetic to say it when the interest rate is so high and the market is taking a little bit of negative downturn. But believe me, over a period of time, on average, not every year, is that around that 7% or so return is probably not too assertive to ask for. But if we conservatively, we say that let's even make it a 6% compounding return over a period of time, I do the maths and I sort of say that, well, 6% on $1 million is about 60,000. That 60,000 on your initial 250 odd grand is about 24%. So the math tells is that there is a 24% return. Now, the trick behind that math is that exactly the point that you said, the leverage. Leverage is a bit of a double-edged sword. If we use it in the right way, it does really good. And if it goes into the wrong way, it can have same level of incremental negative impact as well. So what that means is that one can establish the super fund, one can do all of those things, but still at the end comes back the product, the property that you buy. Is it a right property? Is it really increasing? If the property is increasing, then yes, self-managed super fund with the leverage as well as the control and the asset protection, as we say, are the three main benefits of the self-managed super fund. You've got lots of benefits to it, but the property needs to be right.
Yes, and that's probably a whole nother episode about getting the right property to get those types of returns. And of course, with leverage, you get the upside potential and you get the downside risk as part of it. One of the other risks that I wanted to chat to you about is, let's say we're talking about setting up a self-managed super fund for you. I'm your financial planner. I've got all of this money in this diversified share portfolio. I'm really enjoying the fees that you're paying me as part of that, by the way. I would have a vested interest to sort of keep you in this by saying, look, Munzurul, you're talking about getting rid of all of this diversified, share of overseas listed companies, of ASX listed stocks, of cash and bonds, to go and throw all your eggs into one basket with one, $950,000 property. Is diversification a real thing that we need to think about? And do I have a point as a financial planner, or am I just chasing your fees?
Very, very good question. It's a hard question, right? And look, what I say is that can all taxpayers be expert on every single field of the finance world? And the answer is we can't be expert on every single field. But at the same time, what we try to do with our clients is to help them out where there is enough level of knowledge where they can ask the right question. And we encourage our clients to ask that question exactly what you asked, is both to the accountant as well as the financial planner, right? The same question applies. You as an accountant, are you establishing it because you've got a financial incentive? One is to establish this, and number two is to charge us an annual running cost. So the both argument on both sides, right? My personal view is that while diversification has a merit to it, of course it has got a merit to it. Where I struggle with the diversification on that concept is that you don't have the leverage. Yeah. Say if you have 250 odd grand, is that yes, you are diversifying in a whole lot of assets, you still are doing it at 250 odd grand. Sometimes the financial planner tries to argue saying that, well, I invested in a managed fund, which may itself be leverage. So you've got a bit of a leverage through the managed fund as such. I come back saying that I sort of always found in my case is that the investment that I feel comfortable, the investment that I feel that I've got my passion with, and the investment that I believe that I can add value is that's where sort of the best return from my point of view, right? There is nothing against the shares. There's nothing against the managed fund. There's lots of my clients I've seen they've done exceptionally well with shares and managed funds. I stayed with the property because one is that I could understand, right? So that's what I say to my client. I say that your advisor may say all of those, your accountant may say a different way, but you really truly need to sit down and say, what is my goal? What are my SMART goals? What do I wish to achieve in the longer period of time? Let's say if you're buying a property and you've got an investment plan of say 2 or 3 or 4 years, then I'll probably say buying a property on a self-managed super fund purposes is not the best, because 2 or 3 years is not enough to give you that level of growth. You need a lot longer. Whereas if someone comes in at the age of say early 40s and say, well, I'm not retiring until 65, or at least my retirement age is 65, we are all living into mid 80s, late 80s. That means I've got literally about 40 odd years. Then I do the maths and saying, well, if you're buying $1 million property with $250,000 mortgage, and if it doubles every, say, let's say if the compounding return is 7%, means that if we do the rule of 72, as we say, means that it will double every 10 years. So I do the maths and I say $1 million in 10 years' time. So you're early 40s and you've got about 4 cycles in your hand. So your $1 million now become 2 million in cycle number 1. Next cycle, it became 4 million. Next cycle, it became 8 million. And believe it or not, in 40 years' time, it's $16 million. Now, mind you, $16 million in 40 years, as opposed to today's value, there is a gap, right? Because your typical cup of coffee, which costs $3.50 in 40 years' time, it probably will cost $7, $14, $28, $56, right? So we got to take the perspective into account. But 16 million to a 1 million, and when I divide it by 40 years, that's a very big number in terms of the return. So it gets very hard to beat that with all the rest of the diversification and so. And then I conclude by saying this, Warren Buffett sort of a saying, right? That the old saying from the Warren Buffett is sort of say, whether we sometime look into the diversification and we get too much into the diversification, I would much rather have all my eggs in one basket, as long as I understand the basket very well, completely understand it, and I protect it with my heart and soul.
Yep.
And I take it to that point saying that, in the property world, you can have diversification as well. You can buy residential property, commercial property. You can have a geographical diversification, buying in between Sydney, Brisbane, Melbourne. You can have a structural diversification in between buying house to buy and hold, or house that you buy, develop, build, renovate, sell, or house that you potentially subdivide. Some you can't do it on the super fund, we understand. But I think sometimes diversification is overplayed, my view.
Yeah, look, I think you've if you're speaker one for the affirmative, I don't know what speaker one for the negative is going to come up with. We'll have what you're having, everything except these $56 cups of coffee. I'm not ready to consider my future coffee purchases in 40 years, if you don't mind. Now, Munzurul, we've talked about an ongoing cost of $4,500 to $5,000 as a ballpark, right? And of course, get your own advice on that. I want to know how much it costs to set up. We talked about the statement of advice. We've obviously got to create this thing, and I want to also ask, what is a super fund, as a self-managed super fund, as an entity? What does it actually mean in legal terms, and what can it do, and what can't it do? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Okay, beautiful. So we'll touch two sides of the equation. One is that what is the structure to set up, as well as the cost, and perhaps some of the positive and negative, right? It can do, it can't do. So in terms of the structure, you need a self-managed super fund. Then you need a trustee company. You also need a custodian company. If you are purchasing a property through a self-managed super fund, you also need a custodian deed. So effectively, your custodian company is the legal entity which will be owning the property on behalf of the trustee of the superannuation fund. Your loan would be on the trustee of the superannuation fund. Now, the reason why it is so convoluted and seems to be a bit of a complex, and why do we have poor structure, is because of this concept called non-recourse loan. In the self-managed super fund is that each property has got a simple loan, and that loan is not being collateralized, used, or guaranteed against other properties. Say if someone has 4 properties and 4 separate loans, something goes wrong with this one particular property, that sort of gets taken away. But in theory, the other properties are safe. Outside, there is no such thing as a non-recourse loan, right? Everything is being cross-guaranteed, even if it's not being cross-securitized. So bank created that structure from their protection point of view, from an asset protection from a bank's point of view. That's the structure. And the custodian deed effectively is a contract, which is creating a relationship, saying custodian company is buying the property on behalf of the trustee of the super fund. Yep. Challenge is, because of the complexity, the cost becomes a bit. Process is, you need to have an independent financial advisor to review all of your finance and give you a statement of advice whether super fund is right for you or not. How much they charge, it depends on which financial advisor. It could be anywhere between, I've seen, as low as the 1,500 couple of grand to as high as 10, 12 grand. I think in my experience, it's probably standard about, say, 3,500 is the financial planner. Yep. Then the lawyers need to set up those 3 structure. And again, I've seen various level of cost. Generally speaking, the lawyers sort of charges about a couple of grand. Accountants may charge anywhere between 2 to 3 grand at a start. And I've seen many accountants charging 5, 7, 10 grand. So your standard establishment of all of those, it's a bit of a right fee in my mind, is perhaps whether it's about 8 to 9 grand. Yep. I've seen people trying to charge 12, 15, 18, too much. I've seen financial planners try to charge about 10 grand just to give that advice piece, too much. I think it's about 8 to 9 grand is what we have seen is the right level of cost, makes enough profit for everyone, and is still right from the client. Yep. The why we have this, I suppose there are things positive and negative, right? The positive of a self-managed super fund, you've got a 15% tax rate. Mm-hmm. Capital gain, you get a 1/3 discount, so it's a 10% is the capital gain. If you hold it for longer term, under the current rule, if you're retiring, there is no tax. You've got the asset protection. Even if on a bankruptcy one suggests that your self-managed super fund is quite reasonably protected. So you've got that asset protection, you've got that tax planning. Of course, you've got the leverage, and you also have, I suppose, your control is that you are investing into an asset that you've got passion and interest and control, as opposed to somewhere in the managed one that you really don't know where it is being invested. You're relying on the management of, those larger entities that they're doing the right thing, and the entities are not collapsing. So you've got a bit more destiny that you take it in your hand. Those are the positive. Negative is, there's no question, it's a bit of expensive to set it up, a little bit of a deed to run it. It takes a bit of time to run it. Your interest rate is slightly higher with the bank outside the super fund as opposed to the self-managed super fund. You can't live into that property. You can't have your family, friends living into that property. You cannot do finance more than once on each property. That means he bought a property for $1 million with 800,000 as being borrowing. The property has gone up to 1.5 mil. He can't go back to the bank saying, can I do a top up to use it to buy another property? One loan per property. However, you can buy as many property as you wish to on the self-managed super fund on the same structure. You can't do a construction on the basis of a bank loan. You can use your own cash to do what you wish to on the basis of the investment plan. So there are a couple of restrictions, but there is a whole bunch of benefit for self-managed super fund as well, Mike.
Yeah, and you mentioned, my ears pricked up for a second because you said no tax. Now, we know there's a 15% rate of tax as opposed to, say, as an individual, your marginal rate of tax might be 37 or 45. The CGT exemption is a little bit less than you would have as an individual. But I mean, this is accessing your super fund money, which a lot of young people kind of just see as this mystical thing that one day they'll look at in retirement, but active investors go, well, this is actually an opportunity to invest in another, it's almost like another version of me. I might be doing it in my family trust or my individual name, but I can also do this in parallel as well. So when it comes to retirement, and let's say we are wanting to draw down on this super fund, well, how does the tax situation work with that?
Yeah, good question, right? I think the first comment I must say is that what we're speaking are the rules as it now. And the government seems to sort of always play around with the super fund as a sort of a pocket of gold, and some of the rules and so forth may or may not change. Under the current rule, this is where the funding is, right? And the retirement strategy, or the exit strategy, as we call it, the pension strategy, right? Very complex. You've got a whole bunch of things. So we start with the age of 55. 55, you've got this concept called transition to retirement. And if you fulfill certain criteria, you can draw down up to 10% of your super fund at a very nominal tax rate. And you can do a bit more on the age of 60. When you go into 65, you go into a full level of retirement that you can draw down everything out of the super fund as a tax-free, provided that a certain condition that you fulfill. On the other side of the equation is that you can keep contributing on the super fund, keep running it as an accumulation stage, as opposed to taking it out as a pension stage, all the way to 75. So you can run it to 75, progressively even more if in certain circumstances, but minimum 75, but you can start from the age of 55. And where no tax comes in is that if the super fund gets converted into a pension phase under the current rule, that all the income of the super fund is no tax. And, even at 15% tax, I say that that's just so much better than your highest marginal rate, as you said, right? Or even at 10% CGT, that we say is still pretty good, right? Because the lowest marginal tax rate is about 19% or so. So, Mike, do I say self-managed super fund for everyone? Probably not. But do I say self-managed super fund definitely has a merit for a whole lot of people? Maybe yes. Do I say that in terms of timing side of it, that there is a right level of timing when you do the self-managed super fund? Arguably, yes. Like if someone is 20s and 30s, am I really keen to establish a super fund? I don't know, because it's just too early. Do you have enough fund? If someone is sort of, say, 65, 70, am I very keen to establish the super fund? There got to be extraordinary reason why we're doing it. Is there a right age? I would love to establish, if financial advisors suggest anywhere, say, between 40, 45, early 50s, there is enough level of time for us to do it. The point which I say is that we all living much longer nowadays. Gone are the days that we work up to 60 and we die at 65. Or the life expectancy now is 83 and 87, and it seems to be increasing all the time. So, we used to be doing the financial in the planning arm of retirement of 65 years. Now we do the retirement saying 90 years. And the gap between 65 and 90 is 25 years. That's a big, big bit of time.
Now, you mentioned the political forces at play often tend to look at self-managed super funds as a pot of gold. We've had the changes to self-managed super funds in the news for quite some time now. What is it that we need to understand about these changes, and does it only affect the super rich, like the government of the day will say?
I'm really glad that you asked this question. Do you know why I'm really glad? Is that it's very, very important in my mind is to keep the perspective right and not to run away with sort of, I suppose, the noises in the open world as opposed to the reality. And the reason I say this is that there is a lot of publication in terms of that $3 million funding, right? And sort of say that if your super fund becomes over $3 million, rather than having a 15% tax, we'll charge you more. And sort of there's a lot of anti-publication saying, oh, all the benefits being taken away. It's that Robin Hood sort of a strategy. It doesn't work. It's not only the end, it's also the means. You need to look after the means. All those things that we sort of hear it, and they all have a merit. But we still take a step back, say, let's keep the perspective right. And the perspective is up until 3 mil, we're still getting very discounted rate, which is 15%. And after 3 mil, our rate doesn't increase all the way to highest marginal rate. It goes from 15 to 30%.
Yep.
Now, as an accountant, would I prefer to have 15%? Yes. But would I take 30% as compared to 45%? Yes. And I do, because it is better than your 45%, right? And then not to give away the fact that you've got the asset protection and all the rest of it. So there is a merit to it. But do we over-consider? Probably not.
Yeah, and I suppose if you have a balance over $3 million, chances are you are earning more than $180,000 a year, and you are on that 45% rate. So it makes sense there. So let's say we've got a hypothetical situation of a person who's on a good wicket. They've purchased a number of properties in their self-managed super fund, and they have a balance of $4 million, and they reach retirement age. So that extra $1 million, they'd be paying that higher tax on the revenue that comes from that amount. But what happens when they retire? Are they still able to access all of that and draw that down tax-free?
Yeah, some of those are still going through with the legislation side of it, and some of the technicality that we're still sort of going through, right, with the legislation side of it. But that sort of is the understanding that, yes, one is that your tax, and the second is the conversion of your retirement, right? That the pension phase that you sort of convert, how much of that you convert into a pension phase, right? And the tax rate that you sort of pay. So up to that $3 million is tax free, and after that $3 million is that there would be some tax on your exit as well. But then you strategize yourself, right? Is to say that, well, what do we do? I mean, do we need to draw down? What do we draw down? What portion of it that we draw down? Do we try to draw down on our initial that $3 million? So we're still staying into that tax free, right? So to answer your question, yes, there would be a little bit of tax on the exit. But how much is the tax? And it is still lower. So again, I come back to your point, right? That someone who's earning about $180,000, chances are that that's what he would be earning on that balance. So self-managed super fund on isolation, it cannot be your entire retirement plan. But the view would be whether that stays as a strong proponent together with everything else that you do outside, and they all connect in terms of providing your retirement plan. And the way I sort of explained quite a bit is that initially someone say early 40s and mid 40s is that whether the self-managed super fund is almost a bit of a supplementary, but as time goes on, it starts to become more and more and more and more and more important. And in an ideal wish list is that the retirement, a portion of income coming in from self-managed super fund and a portion of income coming in from outside. And if there is a way, why would we take away the cash more than what we are supposed to, because there is a restriction that how much you got a minimum drawdown as well. Yep. And that sort of increases as the age increase, leave the rest of the money in super fund.
And it begs the question, because you're a man that I know crunches the numbers, and you've just kind of said, look, the self-managed super fund shouldn't be the sole investment strategy. You're talking about people that are buying in perhaps their personal name, or maybe even setting up a company or a family trust. At what point do you sort of say, okay, well, look, we've got a bit of a surplus, or we might have a business dividend or an end of financial year bonus or something. How do you crunch the numbers to say, well, we should max out the voluntary contribution, or we should invest that into the super fund to renovate or develop this? How do you decide which entity is best at that point in time?
Yeah, good, really good question. Really, really good question. The answer to it is that rather than having a theoretical answer or an academic answer, what we try to do is to go a little bit deeper to the client, saying that what do you wish to do? What are really your goals and objectives are? And if the client sort of says that, look, I'd like to sell my principal place of residence to upgrade my principal place of residence, then I would much rather have more cash in our hand so that our new principal place of residence with a higher value gets paid off.
Yep.
And if the client sort of is the other way around, saying that, well, we're downsizing, the kids are grown and kids left, I've got a lot of cash in our hand, then we sort of say, well, how do we use a portion of that cash both within outside the super fund? So you always start with the maximum super contribution, which is 27,500, right?
Yep.
And the benefit of that super contribution in your business entity, you get the business tax rebate, which is 25 to 30%, whereas the super fund, you only pay 15%. So there is a gap in your favor. We sort of start with that question saying that, does your cash flow permit you to do that? Because remembering the cash which goes on the super fund, you can't get excess between 55 to 65, right? So does your cash flow permit it? And if the cash flow permits, there is a merit to it. We do it, right? And then progressively over time, we sort of say, well, do you have enough cash to do what you want to do on the super fund? And you may look into it and say, well, I've got enough to buy a property somewhere, which is a bit of a second graded property, lower quality and all the rest of it. But if I could put in 50,000, 100,000 on this concept called non-concessional contribution, which is a personal contribution, undeducted contribution, you can do up to 110,000 per member, and you can roll over 3 years in one hit, should you wish to. So you can do up to 330,000 and times that by 2 between husband and wife. So you can do all the way to 660, so to speak, in one hit. Right. And then if they have enough cash in their hand, and if there is a genuine logic of utilizing that cash within the super fund to do a whole lot of things, then we explore that whether there is an undeducted contribution is a benefit. I make it loud and clear that if that cash is being taken out of the offset account, for argument's sake, and that means your offset account, your interest cost has now gone up a bit, is that that interest doesn't have any deductibility because you use that on a self-managed super fund. So there is a bit of a negative cost that you need to manage. And then you sort of say that, do I have a use of that additional cash going into the super with a very specific purpose?
Yes.
And if it is, then we explore that.
Yeah, you look at that on merit. Yeah, look, that just sort of says to me that the importance of having an advisor who not only understands it, but face lights up when you ask the questions, such as yours does, is just so incredibly important for property investors to have and to be able to rely on that expertise and that advice for someone who knows that world back to front. Is there anything else that you think, before we finish up, Munzurul, that people really should know about self-managed super funds if they're looking to set it up, or somebody at a barbecue or a seminar is saying, look, you should set up a self-managed super fund?
Yeah, good question. Again, my biggest tip would be is that I'm a big fan of educating. To me, it's all about knowledge, right? It's all about knowing enough so that we can ask the right question to everyone else. So when you hear it on the barbecue, is that rather than jumping into it, what I probably would do is that I'd probably spend a month or two of doing my own self-research. Read everything about the self-managed super fund. Read, and then listen to all the different podcasts. So we've got enough level of knowledge in sort of the self-managed super fund. Then the view would be is to sit down with the accountant and say, give me all the positive and negative of the self-managed super fund. Yep. You also explain to the accountant and then to the financial planner that that's what I want to achieve with the self-managed super fund over a period of time. And once you know all the knowledge, once you quite clearly say what is effectively the investment plan, I'm very tempted to say business plan, but you can't because it's not a business, it's an investment. What is the investment plan in the longer period of time? Quite clearly having an exit strategy that I want to establish the super fund with this bit of funding. I want to buy this. I want to do this. I want to do this. I want to accumulate. Then I might want to sell 1 or 2 properties, pay down the loan, have that much fund in my hand. That gives me a portion of the retirement over a period of time. You almost want your financial planner, with the help of the accountant in terms of the number side of it, to sort of really point that picture and to sort of point that picture, say 5 or 7 years, 10, 15 years in future, only then you establish it. So you don't jump into this self-managed super fund very randomly. You take your time to understand it, explore it. If it is right to you, only then you do it.
I love that, having a plan of what it is you actually want to achieve and investing in the education in yourself. Now, of course, someone like me can't be as clever as you when it comes to self-managed super funds, but I could at least learn enough to ask you the best questions and understand them, right? So I couldn't encourage people enough to invest a little bit of time to ask those questions, because that's where you'll get the best answers and you'll be a partner in your future, right?
It's like going to a doctor, right? And I use that analogy in my mind that, well, the doctor has got all the knowledge, all the theoretical, all the academics and everything else. But and the doctor in theory knows my body as well. But who really knows my body the best? I feel my body, right? So I have to give enough symptom to my doctor saying, this is how I'm feeling. That's what I do. So the doctor makes as much informed decision. And that is what I wish my clients do, is to come in and saying, that's what we want. These are our goals and objectives, so that we can put in the theory with the practicality.
Beautiful. There's a fair bit to it, but the results are there, and as a vehicle, there's so many positives around self-managed super funds if you're getting that right. Munzurul, it's been an absolute pleasure. Thanks for joining me on the Geared for Growth show today.
Thank you very much. Thank you, Mike. Absolute privilege. Thank you.
Cheers.